By May 1st, 2026, the Arabian Peninsula had become an active combat zone. The escalating conflict between the US, Israel, and Iran forced the United Arab Emirates to intercept over 2,200 swarms of drones and missiles. Global energy markets panicked. Traders immediately priced in a massive physical supply shock, and the benchmark price for Brent crude surged past $111 per barrel. Right in the middle of this chaos, on that exact May 1st date, the UAE made a highly calculated announcement. They formally withdrew from the Organization of the Petroleum Exporting Countries, concluding nearly 6 decades of institutional membership. Cartels like OPEC exist specifically to protect their members during periods of extreme market volatility. Quitting during the most severe physical supply shock in the petroleum industry's history seems entirely backwards. The UAE is deploying a massive infrastructural asymmetry to bypass regional paralysis. By executing this exit, the UAE is effectively betting that its own physical assets are more valuable than any institutional alliance, placing the regional security umbrella and the petrodollar system under immediate, intense pressure. To understand why Abu Dhabi left, we have to look at the structural friction built into the OPEC alliance. The entire group relies on historical production baselines and strict daily quotas to enforce collective market discipline and restrict supply. Over the last several years, the UAE executed a $150 billion capital expenditure plan in its upstream sector. This aggressive capital investment successfully pushed the nation's extraction capacity to a massive 4.85 million barrels of oil per day. This chart shows OPEC's operational penalty. With an actual capacity of 4.85 million barrels, a gap of 1.5 million barrels per day remains. Leaving this stranded generates a massive financial penalty. Cartel compliance costs the emirate an estimated $50 billion in annual revenue. Abu Dhabi leadership requires those stranded revenues to fund their post-oil economic diversification, specifically large-scale investments in artificial intelligence, advanced logistics, and renewable infrastructure. Eventually, the financial penalty of collective cartel discipline outweighed the diplomatic benefits. OPEC membership transitioned from a strategic asset into a strict mathematical liability that actively hindered the UAE's sovereign economic goals. The underlying math pushed them to the brink, but the immediate trigger was the maritime blockade. Kinetic naval engagements between the US and Iran have effectively closed the Strait of Hormuz to non-allied commercial traffic. The blockade created profound paralysis. As domestic storage filled, regional shut-in crude ballooned to 9.1 million barrels per day. Trapped within this bottleneck, the UAE holds a distinct advantage: a 400-kilometer overland pipeline transporting 1.8 million barrels directly to the Gulf of Oman, bypassing Hormuz. This bypass is supported by massive physical logistics. The UAE rapidly expanded the Port of Fujairah, increasing its baseline storage capacity to handle incoming crude and ensure continuous export operations. The UAE is removing its output limits at the exact moment its regional competitors are physically unable to get their oil to market. Steel pipelines dictate the reality of this market, overriding diplomatic treaties. Possessing the sole reliable bypass to global shipping lanes, the UAE escapes cartel constraints precisely when it holds a near monopoly on premium wartime pricing. This combination of a physical blockade and a ruptured cartel creates a severe divergence in global paper markets. We are seeing a split reality between short-term spot prices and long-term institutional modeling. In the immediate term, blockaded barrels have trapped millions of units of supply. This sustains a volatile war premium and drives extreme intraday price swings for traders. While near-term prices spike above $111, JP Morgan projects a crash to $60 by late 2026. As bottlenecks clear, unconstrained UAE barrels will flood a market where non-OPEC supply already outpaces demand, creating a dangerous liquidity void susceptible to flash crashes. This exposes an existential threat to OPEC. The cartel relies on deploying its spare capacity to manipulate prices and smooth out supply shocks. By exiting, the UAE just removed the only meaningful source of deployable spare capacity that existed outside of Saudi Arabia. Riyadh now faces a severe zero-sum dilemma. Saudi Arabia must choose between drastically cutting its own production to maintain price floors or abandoning production limits entirely to punish Abu Dhabi for defecting. This dynamic destroys the foundational OPEC bargain. Moving forward, global consumers will either face constant market fragility from a weakened cartel or structurally cheaper energy triggered by a devastating Saudi-led price war. While physical oil markets brace for a price war, the reverberations extend deeply into macro finance. The inability to export roughly 3 million barrels per day via normal maritime channels created an acute dollar revenue gap for the UAE state. This sudden lack of incoming US dollars directly threatened the UAE dirham's 1997 currency peg, risking massive capital flight right in the middle of a regional conflict. This vulnerability triggered highly unusual intervention from Washington. The U.S. Treasury bypassed the Federal Reserve, utilizing the Exchange Stabilization Fund to establish a $20 billion currency swap line with the UAE Central Bank. This form of swap diplomacy is a major historical anomaly. The Federal Reserve strictly limits these permanent facilities to major Western central banks and has never extended one to an Arab nation. The Treasury bypassed the Fed because of a direct geopolitical threat. Abu Dhabi explicitly warned Washington that if dollar liquidity was not guaranteed, they would begin settling oil transactions in the Chinese yuan. The UAE backed this threat with mBridge, a digital currency platform linking Abu Dhabi to Asian central banks, bypassing the US-dominated SWIFT system. Operational data proved its viability, smoothly settling $55 billion in cross-border transactions, while China handled record daily volumes. By combining unconstrained oil production with alternative digital currency settlements, the UAE forced the United States to unilaterally underwrite its financial stability. The UAE successfully negotiated the currency of its energy trades, proving the global petrodollar architecture is actively and irreversibly fracturing. The UAE's unilateral energy policy is permanently reshaping global trade corridors, pulling the center of macroeconomic gravity away from the West. The blockade exposed a deep vulnerability in global logistics. Import-dependent nations are now forced to transition away from just-in-time maritime procurement and instead demand geographically diversified strategic inventory reserves. Abu Dhabi is actively capitalizing on this shift through an aggressive eastward pivot. They are locking in long-term supply agreements and deep integration with India, the world's fastest-growing major energy consumer. The physical manifestation of this alliance is already in place. Abu Dhabi permanently stores 5.6 million barrels of crude oil deep within the Indian Strategic Petroleum Reserves facility in Mangalore. By pre-positioning millions of barrels of crude strictly within the sovereign borders of a major customer, the UAE essentially immunizes its critical export revenues from any future disruptions in the Persian Gulf. This sovereign agility stands in sharp contrast to the institutional paralysis of the fractured Gulf Cooperation Council and the obsolete collective mandates of OPEC. The era of global market stability being dictated by the consensus of a cartel in Vienna has officially ended. The global energy architecture is now driven by a hyper-competitive reality. Heavily armed, financially independent energy states are deploying raw physical infrastructure and digital currencies to secure their own sovereignty, leaving the old world order behind.